Welcome to this explainer. Today, we're taking the abstract numbers of accounting and turning them into the physical, step-by-step journey of a product moving right across the factory floor. We are going to unpack the manufacturing account. Think of this as the absolute, ultimate financial blueprint of production. Let's get into it.
So here's the core question we have to answer. How do you actually calculate the exact cost of goods produced? It's not just guesswork, right? You can't just eyeball a finished product and say, that cost about $5 to make. It requires a highly structured, logical accounting process to capture every single step of manufacturing, turning raw materials into a finished reality. To find that magic number, we'll follow the product lifecycle step by step. We'll cover the purpose of manufacturing accounts, raw materials and expenses, the cost of conversion, navigating work in progress, handling scrap and finished goods, and finally, we'll tie it all together with the T-shaped format.
Section 1. The purpose of manufacturing accounts. Let's look at the ultimate goal here. Any manufacturing business prepares this account right before they even touch the trading and profit and loss account. The entire goal, the whole reason we do this, is to find that final balancing figure, which is the cost of goods produced during an accounting period. That number is then transferred over to the trading account to help determine your gross profit. Honestly, this is the absolute bedrock of your business. If you don't know exactly what it cost you to make your goods, pricing them correctly is, it's completely impossible. And that means calculating accurate profit later on, just a total guessing game.
Section 2. Raw materials and expenses. Time to look at our first ingredients.
Let's see how this builds, starting with the actual cost of raw materials consumed. It's like a giant puzzle, transforming a math formula into the logical flow of your physical inventory. Think about it like this. You start with step 1, your opening stock of raw materials. That's what you literally had sitting in the warehouse on day 1. Then step 2, you add the purchases of any new raw materials you bought during that period. But wait, you can't just stop there. To figure out what you actually used, you have to move to step 3 and subtract, or less, the closing stock of raw materials. Any materials left over simply weren't used to produce goods this time around, right? So they're cleanly removed from the equation.
Now, getting those materials to your assembly line definitely isn't free. Before a single machine even turns on, you have to account for the cost of just getting the materials to the factory doors. We're talking about direct expenses here, whether it's freight, import duties, dock dues for shipping, or carriage inwards. Basically, if an expense is tied to buying raw ingredients and lugging them into your facility, it's a crucial part of your manufacturing cost. So it gets debited straight to this account, no exceptions.
Section 3. The cost of conversion. Let's step inside the factory walls.
Taking those raw materials and magically transforming them into a final product requires a massive amount of resources. Every single expense incurred inside the factory to convert those materials into finished goods is debited here. We are talking about the physical human effort, the wages paid to factory labor. Then you have the infrastructure itself, factory rent, local rates, and factory insurance. And you definitely can't forget the energy needed to keep the lights on and the machines humming. That means motive power, coal, gas, factory lighting, and heating. Finally, we have to account for the physical toll all this takes on your assets. That covers repairs to the plant, machinery, and buildings, plus the inevitable wear and tear, which we record as depreciation. The whole shebang goes right into the cost of conversion.
Section 4. Navigating work in progress. Dealing with semi-finished goods.
Okay, so here's a tricky reality. The factory floor almost never stops perfectly in sync with the accounting calendar. You're always going to have items just sitting on the assembly line that aren't raw materials anymore, but, they aren't finished goods yet either. These semi-finished items are known as work in progress, or WIP, and we have to divide them up logically. The opening work in progress, those half-finished goods sitting there from the very beginning of the period, gets debited. Conversely, the closing work in progress, the items left half-finished at the very end of the year, gets credited. Doing it this way neatly isolates the actual specific manufacturing effort that happened during the current period alone.
Section 5. Scrap and finished goods. Manufacturing inherently produces waste. It's just a fact of life. But in accounting, one factory's trash is literally its own financial treasure. Any amount realized from the sale of waste materials or scrap coming out of your process is recorded right here. Because selling off this scrap actually lowers your overall production costs, it gets credited to the manufacturing account. It's kind of funny, actually. It's a rare moment where making a bit of a mess works completely in your favor.
Now here is a really crucial point you have to remember. Finished goods are left out completely. Seriously, I want to emphasize that. They are strictly excluded. The manufacturing account is dedicated entirely to the process of producing.
Once a good is finished, it graduates. It's out of here. Those stock of finished goods must be adjusted later on in the trading account to find your cost of goods sold. If you were to mix them into the manufacturing account, it would completely distort your cost of production metrics, and we definitely don't want that. Section 6. The T-shape format. Let's look at the final blueprint.
So watch how all these pieces we just talked about snap together into this standard T-shaped format. On the left side, the debit or DR side, you can see all the costs stacking up. You've got your opening work in progress, the raw materials consumed, direct expenses like freight, and that massive list of factory expenses we went through, from wages down to depreciation. Then, on the right side, the credit or CRET side, we have our offsets. This is your sale of scrap and your closing work in progress. When you tally up the left side and subtract those credits on the right, you hit the jackpot. It all culminates in the cost of goods produced. That is your ultimate balancing figure sitting right there on the credit side.
By isolating every single one of those variables, you've successfully translated the physical, noisy chaos of the factory floor into a perfectly balanced financial account. It's pretty amazing when you think about it. But remember, this is just the foundation. Now that you finally hold that precise cost of goods produced in your hands, ask yourself, how will this single, powerful number shape the gross profit in your trading account? Understanding this blueprint is just the first step to mastering your financial destiny, something to chew on. Until next time, keep exploring.